Welcome back to Investing Talk Podcast. We're here to help you cut through the noise and get straight to the insights you need to make informed decisions. Today, we're tackling a question that's probably on quite a few minds. Is Gildan Activewear a good time to buy now? We've got a stack of recent reports and analyses to unpack, and we're going to walk you through all the crucial details. Before we get into Gildan, if you find value in these discussions, please consider subscribing to the podcast, maybe like this episode, or leave a comment with your thoughts. Your support really helps us bring you more of these analyses. And hey, if there's a specific company you'd like us to look into next, definitely leave a comment below. You could also consider buying us a coffee to support our work. All the links are there. Now, let's get to it.
Okay, let's unpack this Gildan situation. They've made a really bold move in the apparel sector, haven't they? We're talking about their acquisition of Hanes brands, which was announced back in July 2025. The sources we looked at highlight this as a very calculated step, designed to really solidify Gildan's position as a global leader. The deal size is interesting.
Some reports say $4.4 billion, others $5 billion. Either way, it's big. And it's framed as much more than just, combining assets.
Yeah, exactly. And what's fascinating here is the strategic thinking behind it. This isn't just about getting bigger for the sake of size. It's really about amplifying earnings resilience and diversifying their revenue streams significantly. Think about combining Hanes brand's really iconic innerwear brands, Hanes, Champion, with Gildan's strong activewear presence and their vertically integrated manufacturing setup. They're trying to create what could potentially be a $10 billion plus apparel giant. It's a major consolidation.
So it's really about creating a synergistic powerhouse then.
Exactly. The goal is product diversification and operational efficiency. For instance, basic innerwear, like Hanes is known for. It provides a pretty stable revenue base, right? Demand tends to hold up even when activewear might fluctuate a bit, maybe during economic downturns.
Oh, okay.
So this move aims to mitigate some of that cyclical risk, create a sort of multi-channel buffer. Plus, it expands them into Hanes brand's retail channel, which nicely complements Gildan's existing wholesale and e-commerce business.
Makes sense. And what about the financial benefits? You mentioned synergies. What are the actual numbers looking like?
The projections are pretty significant. The deal aims to generate $200 million in annual run rate cost synergies by 2028. Run rate just means the ongoing savings they expect once everything's fully integrated and running smoothly.
Got it.
And these savings are expected to roll out gradually, about $50 million in 2026, then $100 million in 2027, and another $50 million in 2028. Critically, these synergies are expected to be immediately accretive to Gildan's adjusted diluted EPS.
Accretive meaning it boosts earnings per share right away.
Precisely. With over 20% accretion once those synergies are fully realized, that translates to a compound annual growth rate in the low 20% range for adjusted diluted EPS over that 2026-2028 period. So really strong boost to earnings potential.
Okay, here's where it gets really interesting for investors, right? How does Gildan's financial health look, especially after swallowing such a large acquisition? And what does that mean for its valuation?
Right. And if we connect this back to the bigger picture, Gildan's financial strategy after the acquisition seems to show a real commitment to balancing that ambition with, financial prudence. Looking at recent performance, they actually reported record second quarter revenue and adjusted diluted EPS back in July 2025. So strong momentum going in.
Okay.
Their trailing 12-month EPS is $3.15, and management narrowed its full-year 2025 guidance, which usually reflects confidence in near-term performance. Analyst projections also look pretty positive for the next year.
And how are they managing the debt that comes with a multi-billion-dollar deal like this? That's always a key question.
Absolutely. They anticipate a net debt-to-adjusted EBITDA leverage ratio of around 2.6 times at closing. Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a common measure of cash flow, so 2.6x leverage. Their stated target is to get back to the midpoint of their usual range, which is 1.5x to 2.5x, within 12 to 18 months after closing. So a fairly quick deleveraging plan. This disciplined approach is really aimed at maintaining an investment-grade credit profile that's crucial for investor confidence.
Definitely. What about their overall valuation metrics? Are we looking at a stock that's reasonably priced? Or has the market already baked in all this potential?
Well, their trailing PE ratio, price to earnings based on past earnings, is around 17.89. The forward PE, looking ahead, is about 15.52. Those figures are generally seen as, moderate to healthy for an apparel manufacturer. Not screamingly cheap, but not overly expensive either.
Yeah.
The company also offers a consistent dividend. The yield is currently 1.57%, which works out to $0.88 annually per share. And when we look at what the analysts think the price should be, they're price targets. The average is near $64.58. There's a range, of course, with a high of $80 and a low of $53.
And the current price is where?
About $56.16 as of mid-August 2025. So that average target suggests potential upside, maybe 15–20% over the next year or so. Compared to the broader apparel industry, Gildan seems to trade at reasonable multiples. It doesn't look particularly overvalued, although the whole sector is facing some pressures.
Okay, beyond the financials, what really gives Gildan an edge? It's a super competitive market out there. What makes them stand out?
Yeah, that's an important question. How does a company differentiate itself? For Gildan, one key aspect seems to be their focus on sustainability and ESG. They're recognized as one of Canada's best 50 corporate citizens, listed among Time's world's most sustainable companies. That's not just fluff. This strong emphasis on ESG, environmental, social, governance, and just general operational sustainability gives them, I think, a significant competitive advantage, especially in a cost-sensitive market like apparel. And their vertically integrated manufacturing network is a huge part of that. We're talking 18 facilities across 10 countries.
That sounds massive.
It is, and it gives them tremendous flexibility in production and, crucially, cost control. They manage more of the process themselves.
So that vertical integration helps with both sustainability and costs.
Exactly. It allows for better oversight, potentially lower costs, and more agility compared to companies that outsource everything. It's a definite edge.
Okay, we've covered fundamentals, strategy, sustainability.
Yeah.
What do the charts say? What's the technical picture and the broader market sentiment towards Gildan right now?
Right, let's look at the technicals. The current price, as we said, is $56.16. Importantly, Gildan is trading above both its 50-day moving average, which is around $49.85, and its 200-day moving average near $48.49.
Which generally signals.
Generally, that indicates an established uptrend. The price has been moving upwards over both the medium and longer term. The 14-day RSI, or Relative Strength Index, that's a momentum indicator, is at 58.49. That's pretty neutral.
So not overbought or oversold.
Exactly. It suggests the stock isn't stretched in either direction right now.
Yeah.
The general trend has an upward bias, but with fairly modest volatility. Things aren't too wild. Now, the broader market sentiment, reflected by the Fear and Greed Index, is actually in fear territory right now, around 39, so general caution in the market. But the sentiment specifically for Gildan seems neutral, maybe tilting slightly positive. It's had 47% green days, positive closing days in the last month, so holding up relatively well amidst broader fear.
And what are the analysts saying? You mentioned the price targets, but what's the overall recommendation?
There's a pretty solid consensus buy rating from the 19 analysts covering it. It breaks down like this. 35% rated a strong buy, another 35% rated a buy, and the remaining 30% have it as a hold, so 0 sell ratings currently.
That's quite positive.
It is. And RBC Capital, for example, just recently, in August 2025, issued a 68 price target. That suggests about a 20% upside from where the stock is trading now, so analysts seem broadly optimistic.
Okay, we've definitely covered a lot of positive ground. Strategic vision, decent financials, positive sentiment. But every investment story has potential downsides. What are the big buts and ifs? What are the potential risks for Gildan?
Right, and it's crucial to balance that strong strategic vision against the potential hurdles. I mean, the biggest one, arguably, is integration risk. Merging two large companies like Gildan and Hanes brands, each with its own distinct culture, systems, operational models, that's incredibly complex.
Yeah, integrations can be messy.
They really can. Any delays or hiccups in making that integration seamless could definitely put pressure on short-term earnings. It's a major execution challenge. Also, there's that strategic review of Hanes Brands Australia. They might sell it off. That introduces a bit of uncertainty about the final shape of the combined company.
What about risks specific to Gildan itself beyond the integration?
Well, there's always execution risk, right? What if demand for apparel softens more than expected? Or if cost inflation bites harder and erodes their margins? Competitive pressure is always there, especially from fast fashion players. And of course, Gildan's performance is tied to North American and global macroeconomic cycles. A recession would hurt.
And what about broader sector risks? Things that could affect the whole apparel industry?
Yeah, the whole sector faces cyclical demand. People cut back on clothes shopping when times get tough. Supply chain disruptions are always a potential threat, though Gildan's vertical integration might help mitigate that somewhat.
True.
Consumer discretionary spending as a whole is vulnerable to macroeconomic shocks, inflation, interest rates, job losses. And specifically for this deal, cross-border acquisitions in concentrated markets. The U.S. innerwear market is pretty concentrated, with Hanesbrands and Gildan being big players.
Yeah.
That can attract regulatory scrutiny or antitrust challenges. It's something to watch.
And the debt load, even with the deleveraging plan.
Yes, absolutely. Need to monitor that combined debt load closely and make sure they stick to that plan to bring it down. Any slip-ups there could worry investors.
Okay, so pulling it all together, the ambitious acquisition, the potential synergies, the sustainability angle, but also these integration challenges, market risks, debt concerns. What's the overall investment thesis? Is Gildan a buy right now?
Based on, synthesizing all the sources we've looked at, Gildan Activewear gets an overall rating of about 7 out of 10. The thinking behind that is, well, it demonstrates pretty solid financial health, definite upward earnings momentum, and that positive analyst sentiment we talked about.
Okay.
The valuation seems reasonable, offering moderate upside potential based on current targets, but those cyclical and sectoral risks, they definitely persist, and you can't ignore them. The technical picture shows a stable uptrend, which is encouraging, and their focus on sustainability, which is becoming increasingly important, combined with consistent results, supports a generally bullish outlook, especially for the intermediate term.
So more of a long-term play than a quick trade?
I think that's fair to say. The investment horizon for Gildan seems better suited for a longer-term approach, given its fundamentals, the stable dividend, that ESG positioning. The primary case really feels like holding it through the inevitable ups and downs of the market and the sector cycles, aiming for those compounded returns over time. Sure, a short-term trade might capture some modest upside based on current sentiment, but the real value story here seems to be longer term.
So to circle back finally to our original question, is Gildan Activewear a good time to buy now? The analysis seems to suggest a pretty strong long-term case, driven by that strategic diversification, the significant cost synergies potential, and what looks like a disciplined financial approach. Though, as you said, those integration complexities and the broader market risks certainly warrant careful ongoing monitoring. It's not a slam dunk without caveats.
Exactly, and maybe this raises an important question for you, the listener, to think about. Looking at the long game for any company, really, beyond just achieving scale and efficiency through deals like this, what other qualities or strategies might a company need to truly dominate and sustain leadership in a constantly changing industry over decades? It's something to mull over as you consider your own investment decisions.
That's a great thought to end on. And that's all for this look at Gildan Activewear. We really hope this analysis has given you some valuable insights and clarity. If you did find this helpful, please consider subscribing, maybe leaving a review, or letting us know what companies you'd like us to look into next time. We do read those comments. Thanks so much for listening.